Hello, everyone, and also welcome to today's webinar session, and thanks so much for joining us. My name is Monique Charland, and I'm the CEO of Business Accounting Network, a national franchise company, and we're the first and leading professional accounting, business advisory, and tax franchise in South Africa. And our approach to the services our accountants provide your business has always been about encouraging you to invest proactively in managing risk, particularly related to compliance. In other words, that complex and daunting law governing business in South Africa today, as well as financial and tax risk. So in our capacity as accountants and being business owners ourselves, we've identified key areas where small businesses and their owners miss out on the guaranteed way to mitigate risk in their business. And so we would like to do some investing of our own by showing you, by way of complimentary monthly webinars, the common mistakes we see business owners make and how you can avoid them. So today we are presenting directors' duties and responsibilities. Eventually, close corporations will either be required to convert to companies or go back to trading as sole proprietors. So this presentation should be of interest to all business owners who are already directors in a company or who are considering becoming a director of a startup or even an existing company. And our host and organizer for today's webinar is Shane Webb, who is usually based in Hilton in KwaZulu-Natal, but I understand he's in Pretoria today. And I'd like to introduce you to our presenter today, Madeleine Pretorius. Now, Madeleine is a band franchisee owner. She's based in Paarl in the Western Cape. Together with myself, heads up technical training within the band franchise group. Madeleine qualified as a chartered accountant in 2012 after completing her psycho articles at PricewaterhouseCoopers in Gauteng, and is a registered CA with the South African Institute of Chartered Accountants. Just a little bookkeeping for those of you that have, housekeeping should I say, not bookkeeping. For those of you who have just joined us, we would love to hear from you. So if you have any questions during the presentation, please type them into the question box in the right-hand panel or the right-hand control panel. We will have time for questions at the end, which Shane will address for the panel, being Madeleine and myself. And the session today is being recorded. If you would like a copy of the recording of this webinar, please just email Band's head office at info@band.co.za, or otherwise just go to our website. Our email address is there. And Shane will explain later about how to download additional material. So now, without any further ado, I'd like to turn the time over to our presenter today, and that's Madeleine Pretorius.
Hi everyone, thanks for joining us. I'm really excited about these webinar sessions because I do believe it can give you a lot of interesting information and necessary information for you to be able to run your business more efficiently and with more comfort. Now today we are looking at specific sections of the Companies Act, and specifically also the New Companies Act. The New Companies Act is quite a balanced act compared to the prior or Old Companies Act. And for our purposes today, the section that we are looking at in terms of the duties of company directors, the main purpose of any additions that the New Companies Act has made and changes and things like that is really just to protect the company itself, to protect the shareholders, and still give the company directors enough authority and almost capacity to fulfill their duties that they need. I'd like to start with some background on the New Companies Act. The New Companies Act was signed into law on the 8th of April 2009, and it became effective from the 1st of May 2011. Now, under this new act, any business and affairs of the company must be managed or be under the direction of its board of directors, and this board of directors is given the authority to exercise all of the powers and perform all of the functions of the company, except to the extent that there are some provisions of possibly the Act or the company's memorandum of incorporation that provides otherwise. Now, you might read the New Companies Act and see that they refer to the board of directors all over, but you might be a one-man show or an owner-managed business, and you might feel, but that doesn't necessarily apply to me because I don't have a board of directors in my company. I'm not that big. It doesn't matter. The New Companies Act applies to any size of business, whether you are a micro-sized entity, small, medium-sized, or a large listed corporate. Even though the terminology relates to board of directors, the Act actually provides that a private company must have at least one director. So if you're owner managed, you still have to comply with the Companies Act. I'd like to also refer to the Memorandum of Incorporation, or MOI, for those of you who might be unsure. Your MOI is the founding document of your company. Under the old Act, if your company was formed prior to 2011, your MOI or your founding documents would have consisted of two documents, the original MOI and the Articles of Association. And with this new Act coming into effect, there was a requirement for you to convert your old founding documents into this new Memorandum of Incorporation, or single founding document. If you haven't done so, or you are not sure whether you have done so, please, I urge you, go and have a look at your founding documents to see whether you actually have converted them to the new documents required by the Act. This Memorandum of Incorporation, or MOI, is extremely important because under the new Act, it is intended to be binding on both the directors and the company and each of the members of the company. And it almost also acts as a stronger form of, I want to say legislation, but that's not necessarily the right word, but almost a stronger form of requirements than the Act, because if there is something stipulated in your MOI, it could possibly, that is different to the Act, it could override it. So it's extremely important now to know what are the requirements or your certain specific sections in your MOI, because you might be thinking, okay, I comply with the new Companies Act, but you might be in contradiction to your MOI. So if you're not sure where your MOI is, or you might not have a copy, please go and pay the necessary fee, go and request it from SIPC, get a copy, go through the requirements and see whether everything is in order. If you need to change it, you can amend your MOI through either a court order or through a special resolution. And to give you an example of when your MOI might be in contradiction to the Companies Act is with the PI score calculation. Now, for those of you who are not familiar with the PI score is the public interest score of the company. It is a calculation of a number of points that are allocated to the business per certain requirements. So, for example, you could get a certain number of points per number of employees that you have, or 1 point for every 1 million rand turnover or external liability that your company might have at the end of the year. And based on that calculation of a specific number of points, you might fall into a PI score bracket. And that basically determines whether your company needs to be audited, whether you are okay just to have an independent review, or whether you merely need a compilation of your financial statements for your own and for tax purposes. However, even if you calculate your PI score, but your Memorandum of Incorporation has not been updated or amended, and it still has as a requirement that you need to be audited, whether you are a micro entity or not, you are in contravention if you do not then audit your company. So it becomes vitally important that you are aware of what is sitting in your MOI and whether it actually agrees to what your business structure is. Prior to the introduction of the Act, the duties of company directors were governed by South African common law, so they weren't specifically part of legislation. And under common law, the duties that we saw most often were the directors having to act in the utmost good faith and in the best interest of their companies, and to exercise care, skill, and diligence so as to promote company success through independent judgment. The Act, however, has now taken these common law duties and put them into statute. They've also added a few extra duties which don't really change the original duties, but they've actually made them law. So you can't actually get by now by saying, oh, well, I wasn't aware of the common law. It's in the legislation now. So the duties of directors have been extended, and with that, your accountability of directors has actually increased as well. On that note, for example, just going back to your PI score, one of the duties of the directors is to calculate that PI score every year so you can see that as a director of the company, it's not just running your business. You need to be aware of all the extra bits that the legislation has brought in that you need to take into account and kind of make sure that your business is dealing with. So when we look at the term directors, what does the Act actually consider a director? What is it considered to be a director? Now, everywhere in the New Companies Act, there are certain persons or bits of the definition that are included in directors. But for our purposes today, we can focus on these two points to be included in the director definition. Now, the first one is that a director is defined to include a prescribed officer, and a director, as defined, is also a person who is a member of a committee of a board of that company, if it is applicable, if your company is large enough to have board of directors, or an audit committee, irrespective of whether the person is also a member of the company's board. And that's where the important part of that definition comes in. So it doesn't matter whether you have specifically been appointed as a director with SIPC or not, whether you have the title of director, whether you have been registered as a director, whether you are running the company or not, you might still be liable, or could I say, the company requirements could still be applicable to you in terms of the duties of directors, even though you haven't been appointed as a specific director. So if we look at the Companies Act and going further into the definition, a prescribed officer, who is a prescribed officer? It is anyone who exercises general control over management. So for example, a general manager, or it could be that you're a head of a specific or significant division of that company. So you could be a head of a division, or you could be running a major key element of that business. Or it could be anyone who regularly participates in executive management, who's involved in decision-making, you've got control over certain activities. You don't necessarily have to be a member of the board of directors. You don't have to be a director as such. And just remember also, once again, if you're a small entity, you are owner-managed, you might say, okay, but I don't have a board of directors. It doesn't matter, even if you are not actually specifically the director, but you run the company, you still have to comply with these duties. So for example, you might be an owner-managed business and you feel, well, you really want to limit your liability as a director, and you feel maybe that your spouse would be a better person to be appointed. They would take on the role of director in terms of statutes, so they will be appointed as the director in terms of the company in terms of SIPC, but they don't necessarily perform the activities of the company or running of the company. You do that. So maybe they have less assets in their name, so you feel if the creditors come around, they will be less, they won't be liable as much because they don't have any assets. But if any matter comes to light and it becomes in front of a court of law, they will look at the facts of your company, and they will look at how is your company structured, who is actually responsible for executive management, whether you have been appointed as a director or not, and you will be held accountable for the actions, or for your actions and for the matters of the company. So that's an important thing to remember, because even if you are not really, strictly speaking, a director as such, you are still acting as a director in terms of the Companies Act. The courts of law will also look at the structure of each company separately, so it's dependent on fact. So it's not a generalized issue. They will look at each company separately and see how it has been run. Let's look at the first duty that a director is required to comply with in terms of the new Companies Act, and this is the duty of care and skill. This duty has been derived from common law, and it has now been included in the Act expressly so that you can immediately see it. You cannot miss it. You can no longer plead ignorance. It draws your attention to it. And under the duty of care and skill, a director is required to act with care, skill, and diligence, and that care, skill, and diligence must be of a certain level. So it could be at the level that you could be expected from someone with that director's knowledge and experience, and that's an important one, the and over there, from a reasonable person in that director's position. Now, what does that mean? It means that if you are a director with above average skills and experience, more is going to be expected of you in your role or your capacity of as a director, or as someone acting as a director, and in terms of your actions, because you have that skill, you have that above average experience. However, you cannot plead ignorance anymore. That to say that you are not maybe formally qualified, or you don't have the experience in terms of financial matters, because this duty of care and skill that has been legislated tests every single director from a reasonable person's point of view. So the reasonable person average. So even if you might have below average skills in terms of experience as a director, that will be no excuse, because they stop the test at a reasonable average person. That's important to remember. So the duty of care and skill looks at how much diligence and application of your skill you actually put into your director's duties. Our next duty in terms of the Companies Act are the director's fiduciary duties. Now, the director stands in a relationship of trust to both the company as well as its shareholders, if that is the case, if your company is large enough to have distinction between the directors and the shareholders. So that fiduciary relationship is also derived in terms of the duties from common law, and it has expressly been stated once again in the Act now so that you cannot miss it. You have to comply with it. Now, in general, the fiduciary duties of directors are to act in good faith for a proper purpose and in the best interests of the company. And when we look at specific fiduciary duties, we can see that a director has a duty not to exceed his powers as a director, to exercise those powers for a proper purpose, to maintain an unfettered discretion, or to look at independent decision-making. He has a duty not to compete with the company, and also a duty to avoid conflict between a director's interests and the interests of the company. And this includes a financial interest as well. So when we look at the fiduciary duties, we mentioned before that your MOI or your founding document could possibly override some regulations in the Act. However, it specifically states that your MOI can never relieve the fiduciary duties required by a director. You can possibly use your MOI to change the way that you actually fulfill these duties. For example, if there is a conflict of interest between the director's interests and those of the company, the way that you actually then deal with that conflict of interest could possibly be stipulated in your MOI and could be different to what the Companies Act says. But in terms of kind of nullifying your fiduciary duties, the MOI can never do that. Let's look at an example of a conflict of financial interest between the company and the director. Say, for example, you are a director and you could be the single director or possibly an owner-managed business, and you continue paying yourself a salary or even bonuses or drawdowns from the company, even though the company does not have enough cash flow or possibly profits to continue servicing creditors, to pay them, or even to pay your SARS VAT. That is a gross breach of your fiduciary duty, because how can you take cash out of the business for your own purposes where you know the business is not actually being able to be serviced? You cannot actually pay your creditors, you're not paying SARS. That's a conflict of financial interest. And it could actually be extended, because you might think, oh, well, I'm an owner-managed business. It won't necessarily matter. I can just carry on with the business. It's not a problem. But it extends beyond just the Companies Act duties. And that is something that we'll look on in follow-up on sessions to this webinar. For example, the Tax Administration Act. If you carry on trading without being able to pay your taxes or to SARS, or you knowingly take assets out of the business without first paying tax liabilities due, you could be liable to a criminal offence which carries a jail sentence of 2 to 5 years. So you can see that it suddenly becomes extremely serious, and that these fiduciary duties, which could possibly feel a little bit airy-fairy, are actually very, very important, and they have ongoing or follow-up consequences. Another duty that the Act kind of describes further is independence of action. So a director must always act independently of any outside restraint or consideration, and solely in the best interest of the company as a whole. And that's an important concept, the company as a whole, because the Companies Act has to take into account that there might be larger companies that are also applicable. And here we are looking at then a split between your shareholders and your directors. And a director needs to act in the best interest of the company as a whole and also the shareholders as a whole. A director must also vote independently at any meetings or for any decision making. The director must recognize the inherent potential of conflict of interest and always be aware that a conflict of interest could arise. And he or she must accept that the primary duty of a director is always to act in the best interests of the company. And that doesn't only include your current interests, it also looks at future shareholders and the long-term interests of the company, because you want to look at sustaining this company going into the future, and that is one of your duties as a director. Something to look at or something interesting to consider is the position of a director who has been appointed to the board. This is now considering that you have more than one director, as a representative of a major shareholder or creditor. So if you're a director sitting on the board of a company and you're actually representing a major shareholder creditor, could you possibly be acting with independence of action? Can you? Because you need to keep your shareholder creditors' interests into account. And there could be a conflict between their interests and the interests of the company or the shareholders as a whole. So that becomes extremely difficult and conflicts of interest could arise. Let's look at the duties relating to a conflict of interest if that does come into play. Now, the duties relating to a conflict of interest, as I mentioned before, can be altered by your MOI, for example. But just looking at the basics, these duties are regulated by common law, the New Companies Act, and King 3. So let's have a look at these. Your common law fiduciary duty in terms of conflict of interest is to avoid any conflict of interest between a director's interests, his own interests, as well as the interests of the company. So you never want to be in a situation where you might have to consider whether your interests should come above those of the company or not. The Act requires directors to disclose, in relation to matters that are considered at directors' meetings, their own personal financial interest in that matter, if there is a conflict, or, and this is quite important, the personal financial interest of related persons in that matter that the director both knows of, and this is interesting, or ought to have known of. So if you have, as a director under the new Act, a financial interest or a conflict of interest in a certain matter of the company, it's not just you that the courts of law will look at. They will look at any of your related persons too. And in terms of the Act, this is quite a broad definition. Related persons include persons like, for example, spouses, family members to a certain degree, or any other company or CC that you also might be a director of or a member of. It's quite wide. So it's not just your conflicts of interest, but your related persons too. And it's those personal financial interests that you ought to have known of. So you have no excuse to say, oh, but I didn't know. As a reasonable person, would you possibly have ought to have known of that? And the courts will actually look at that. So you can immediately see that the accountability of the directors are immediately more, because the courts are putting it back into your ball back into your court and saying, hey, but listen, you're the director, you've been given this authority, you need to take accountability for it. And the King 3 report, for those who have not heard of that before, is a report of recommendations for directors and companies in terms of how they should run their affairs and committees they might have and things like that. It is also applicable to all different structures and sizes of companies. However, from a practical point of view, it is not necessarily always applied in the small and medium-sized entity market. It's usually for the listed corporates, because it does get quite onerous and quite expensive to apply. And there are recommendations that you could use in principle, but it isn't necessarily applied always in terms of cost efficiency. But in terms of this King 3, the King 3 recommendations for conflicts of interest says that they should be avoided. Otherwise, they should be disclosed in good time and in full detail to the board, and then appropriately managed. So conflicts of interest becomes quite a topical point with regards to the New Companies Act. Let's look at it though from the point of an owner-managed business. If you are the only director, it becomes then extremely important, because your responsibility is even more then to act without any conflicts of interest, to maintain your duties, and to actually act with integrity and business ethics, because you as an owner-managed business then don't have other directors or possibly separate shareholders who hold you to account. One of the duties, or another duty of director, is to prevent or kind of make sure that the company never goes into reckless trading as defined in the Act. Now, what does the Act see as being reckless trading of a business? If you carry on business recklessly with gross negligence, with the intent to defraud a person for fraudulent purpose, or if you are unable to pay your debts as they become due in the ordinary course of business, all those things are considered reckless trading. Now, if you look at those or consider those points, if you, for example, as a director of a company or a person who is managing that company, and you know that you have not got your accounting records up to date, they're not accurate, they might be outstanding, never mind your taxes, Could you possibly be considered as acting with gross negligence? Because if you have suppliers that you need to pay and debts that you need to service, how on earth will you know how much to pay them and when to pay them, and whether you are actually meeting those requirements if you don't have accounting records? So your accounting records are an indication of the negligence or shall I say, compliance with the duties of directors that you have. You need some sort of financial reporting on a monthly or regular basis, preferably something like management accounts, which includes your balance sheet as well as your income statement, cash flow and projections and things like that, so that you are able to make sure that you don't come into a position of reckless trading with your business, that you can look ahead and make decisions for your business that is based on accurate information. At the bottom here, unable to pay debts as they become due in the ordinary course of business. How will you know whether you can pay your debts if you don't have this information available? You might say, okay, but I'm appointing an accountant to do it. Sure, but how does the accountant know what decisions to make, or the professional person, if they don't have the information to make it? If there are no accounting records set up, they don't actually have the source documents, anything like that. So that's an important duty that is derived from the requirements of the Companies Act for the directors. You can also link that even to not only your creditors that you cannot pay, but maybe SARS. Remember that you are standing in a fiduciary duty or a fiduciary relationship between you and SARS, the company and SARS, because the VAT that you need to pay over to SARS is not necessarily your gross profit. It is VAT that it is a duty that is collected on behalf of SARS by you, and it needs to be paid over. And any breach of that could also be seen as possible reckless trading or the intent to defraud a person or SARS in that matter, for that matter. So these become extremely important, and you can see as we go along that the directors are running the company, but they have a lot to keep in mind as they do that. One of the consequences of not meeting or complying with the director's duties is what they term a reportable irregularity. Now, under the Companies Regulation number 29, a reportable irregularity is defined as any act or omission committed by any person responsible for the management of a company, which unlawfully has caused or is likely to cause material financial loss to the company or to any member, shareholder, creditor, or investor of the company in respect of his dealings with that entity, or is fraudulent or amounts to theft, or causes or has caused the company to trade under insolvent circumstances. Now, I'd like to highlight a few points in this definition and describe them a bit in more detail. So, act or omission committed by a person responsible for management. So once again, it's not just directors. It includes prescribed officers and persons who are acting in a controlling duty of that company. Unlawfully has caused material financial loss. And here you can actually think about it in this way. The common law duties that we've discussed previously, like duties of care and skill, acting in the best interest of the company, those things are part of legislation now. So if you breach those duties and something happens in the company, you have been unlawful, and it could be a reportable irregularity. And then this concept of material financial loss, materiality, which the new Companies Act brings in. It looks at the materiality of what happened, not just quantitatively, in other words, in terms of value, but also qualitatively in terms of its nature. And then we also need to emphasize the fact that if you are trading under insolvent circumstances, it is an immediate reportable irregularity as well. But you could say to yourself, okay, but so what? I might have a reportable irregularity, but I'm a one-man business. Who's ever going to know about this? Well, you need financial statements as a company to be able to obtain financing, or definitely to submit to SARS in terms of your tax return, your company's tax return. And how do you get those financial statements? Somebody has to compile them, even if you don't do them yourself. If you have a certain PI score, they might need to sign off. And any reportable irregularity that is found will have to be reported in your financial statements. So you can see that could have an impact immediately on your ability to get financing, your liquidity and solvency of your company, and eventually reputational risk as well. And something interesting to note is that it's not just the auditors that have to report a reportable irregularity anymore. A recent change in the Code of Conduct for Professional Accountants now has the requirement for any professional accountant in public or private practice to go and investigate and look and report a reportable irregularity. So it could even be an outside creditor. So you have to be aware of this. Let's look at some examples given by the Act. Trading recklessly, which we looked at previously, the existence of fraud, trading under insolvent conditions. Now, insolvent conditions, just to give that, to give a bit of more explanation, if you do a calculation in your company and you look at your assets and liabilities, if you take your assets and you minus your liabilities from that, and obviously excluding inventory because it's quite an illiquid asset, if your liabilities exceed your assets, you are in an insolvent situation or an insolvent condition on your balance sheet. And if you carry on trading while your liabilities exceed your assets, that could be or is seen as a reportable irregularity. And as we saw previously, that is reckless trading as well. Not meeting your solvency or liquidity test. Now, what is that? The solvency test is what we just spoke about. Assets less liabilities, and if the liabilities exceed your assets, then you're considered insolvent. And your liquidity test looks at whether you can service your debts in the ordinary course of business. In other words, if you've possibly got a loan with a bank and you need to pay interest on that as well as capital, and you've got creditors and suppliers that you need to pay, you even have SARS, is your business liquid? Do you have enough cash flow to be able to pay capital and interest as it is demanded? And whether you can actually continue paying your working capital and your suppliers. That is your liquidity test. So if you don't meet that test, it's a reportable irregularity. Theft, if we carry on with this list, legislation, so it's not just the Companies Act, or any illegal acts. Those are considered reportable irregularities. So you can see it's quite a hefty consequence, or one of them. Never mind the actual liabilities that the directors could incur. Let's have a look at a concept that has been introduced by the New Companies Act that is fairly new to, or possibly that you haven't seen before, and this is called the business judgment rule. Now, the purpose of the business judgment rule is to prevent any directors from being held liable, with the benefit of hindsight, of course, for honest errors of judgment. So if you honestly dealt with matters in a certain way and you felt you were doing the right thing, then surely you shouldn't be held accountable for that. And that is where the business judgment rule comes in. So for any matter arising in the exercise of powers and the performance of the functions of a director, the business judgment rule says that that director is entitled to rely on the performance of any of the persons referred to in the Act, and we will look at it in a couple of slides who these persons are. And that director is entitled to rely on any information, opinions, recommendations, reports, or statements, including financial statements and financial data, that have been prepared or presented by any of the persons specified in the Act, which we will have a look at a bit later. So in other words, as this director is fulfilling his duties, he is allowed to rely on other professional persons or on other persons that have been specified. So he doesn't have to feel that he needs to comply with all of the duties and then he won't get to all of it. He is allowed to rely on the performance of other persons, but there are specific requirements. And when those requirements are met, then you possibly have some protection under the business judgment rule. Now, one of the overarching or umbrella requirements for this rule to be applicable in any way is that the director must show that he acted with the duty of care and skill, which we looked at previously, as well as independence of action, that he acted in the best interest of the company. If those requirements are not met, he didn't act in the interest of the companies, there might have been conflict of interest or anything like that, then the business judgment rule will not apply to that director. So there are 3 requirements in order to be protected by this business judgment rule as a director. You must have made an informed decision. There must be no self-dealing or conflicts, or you should have properly disclosed any material, personal, financial interest of you or yourself or a related person. And there must be a rational basis for believing that the director was acting in the best interest of the company. So you must be able to demonstrate that you believed that you acted in the best interest of the company. And only then, if all these 3 things are met, as well as the fact that you acted with the duty of care and skill, then you might be protected under the business judgment rule. Something just to kind of highlight is this concept of making an informed decision. An informed decision implies that you had enough information available to consider all the facts surrounding that matter that was on the table, and that you had everything that you could. You had enough knowledge to be able to make a decision that is in the best interests of the company. So that implies, though, if it's something in terms of the company, in terms of financial matters or something, that you have financial records, correct? So once again, we get back to that concept. complete and accurate financial records, management accounts to be able to make decisions. Let's have a look at who the persons are that the director can rely on. A director, according to the Act, can rely on the employees of the company, but only if they are reliable and competent in the functions they perform or the information, opinions, reports, or statements that they provide. So the director must believe that he's working with a good employee. He's reliable, he's competent, he can rely on that information. The persons also include the board of directors. In other words, if you are a company with more than one director, if you as a director need to make a decision, you can bring in another director to help you. If you believe that the matter at hand is within that particular person's professional and expert competence, and if that person merits confidence. And that's a concept that comes through quite often in the Companies Act in terms of this business judgment rule. That person that you use or who you rely on must merit confidence. In other words, they must know what they're doing. And you must believe, honestly believe that they know what they're doing. It also includes a board committee, if that is applicable to your company, of which you as a director are not a member. So you don't have to be a member, but you could rely on that information. Unless the actions of that committee do not merit confidence. So once again, we look at that concept. And here's kind of the highlight of what we are looking at today. Directors are allowed to rely on legal counsel, accountants, and other professional persons in order to make their decisions. But there are certain subjects or subject to certain provisions. So legal counsel, accountants, and professional persons must have been retained by the company. What does that mean? It means you need to have assigned terms of engagement, a contract or a mandate with that professional person as evidence that you have actually brought their services on at the company and that has been authorized and it is official. And that terms of engagement or mandate is very important because it sets out the responsibilities and the duties of this professional person, as well as your duties as a director, and it sets out the scope of the duties or the limitation of scope as well. And anything beyond that is ultimately your duty as a director. And importantly also, you can't just bring in any professional person and rely on their opinion. You need to retain someone, according to that matter, who has the skills or expertise for that matter, and it is their professional or expert competence, and that they also merit confidence. So it's exactly the same concept again. So the director is entitled then to rely on professional persons, but the ultimate judgment and decision making is still the director's. It's his responsibility. You must still continue to exercise due care and skill. You cannot hide behind reliance on expert opinion, unfortunately. Let's give an example of this. Let's say you are a director of a company and you're looking to grow your business, which you would naturally want to do, and you're acting in the best interest of the business and you're getting customers together and trading, you want to increase your turnover and things like that. And there's a major customer that you want to sign, and you can see that it's actually going to put your business on track. It's going to put you in the right growth direction. It's a big customer and you really want to sign them on because it's good for your business. So just to quickly go back to your requirements, what do? You want to make an informed decision, right? So as a director, you go to your employees or whoever has been appointed to work with your debtors, and you say, please go and do the background checks that are necessary for this customer. It's a big customer. Do credit checks, phone around, read the newspapers, do whatever you need to do to get as much information as you can to make a decision as to whether we can or should take on this customer, whether it's good for our business. And that you delegate to one of your employees. You act with care and skill. You act in the best interest of the company. There's no conflict of interest. It's a completely independent customer. And you believe that you are honestly acting in the best interest of the company because this will grow the company. It's going to increase your revenue. It's the right thing to do. And then after you actually conclude the deal, you've contracted with a customer, you have possibly on your side contracted with suppliers, bought inventory if that is applicable. You might have incurred extra costs. Increased creditors, things like that, because you know you're going to have to service this customer. The customer then defaults. They go insolvent and they aren't able to pay you. What then? Is this director supposed to be held accountable for signing this major customer and suddenly your company might be in an insolvent position because you can't pay your creditors or you can't pay off your debt? You might have taken out a loan to be able to run your business in anticipation of this major customer. Well, under the business judgment rule, you could say no. In that case, you are offered protection because you acted with duty of care and skill. You acted in the best interest of the company. There was no conflict of interest. And you are allowed to rely on the employees of your company to be able to do specific or background checks and gather all the information. You are allowed to rely on that information. And then under the business judgment rule, you would be offered protection as an honest error of judgment. You couldn't possibly have ought to have known that this customer will default. Right. And that is basically, or kind of in a nutshell, an example of how the business judgment rule could work. Which directors, however, will not be protected under this business judgment rule? As we've said before, if you do not meet the duty of care or skill, or you do not act in the best interest of the company with independence of action. And then there's a new requirement that the Companies Act introduces that hasn't been there before. It's a new duty. And it says that any director who is not acquainted with the financial affairs of the company and allows that company to continue trading when it is unable to pay its debts as they become due and payable in the ordinary course of business will not be protected under the business judgment rule. In other words, if you are continuing to allow your company to trade under insolvent circumstances, you will never be protected. And once again, we come back to financial records of that company. How are you acquainted with the financial affairs of your company as a director if you know that your accounting records are behind? Do you know that you are able to pay your debts as they become due, or you're not so sure because your supplier age analysis is not up to date? So that becomes vitally important, because the directors must now be able to identify and recognize the stage at which the insolvency of the company is imminent. So if you know we're about to go insolvent, you need to know that and you need to act. You no longer have an excuse because it's part of the legislation now. It is now, as a director, your statutory duty to know what the company's financial position is. You cannot remain ignorant of the affairs of the company anymore. And you can see under the business judgment rule even that you are not afforded any protection if you don't know what's going on with the financial affairs of your company. That is one of the core duties as a director. And you might once again say, okay, but I'm owner managed, who's even going to know? Well, if you're not paying your suppliers, they might get a bit antsy and they might do some investigation and they might say, oh, but wait a minute, you're about to go insolvent. But you don't have records, you're a mess, you're not paying people you need to pay. And they could report you. Any outside person could report you as a director. And it could lead to a criminal offense if you don't keep your accounting records up to date. But we will look at that in follow-up webinars. So it really does become important that you can see that there are almost roll forward effects that has for the directors if you don't comply with your almost basic duties in terms of running the affairs of the company. And when we talk about accounting records, once again, it's not just your trading or your income statement, it's your balance sheet as well. I would also recommend cash flow. Know what your cash flows looks like. Know what your bank statements or your bank accounts look like, and also look at cash flow projections to know whether you are going to be able to pay your debts in future or not. So, liability of directors. And remember, it's not just whether you've been appointed as a director. This includes prescribed officers as well, executive management. Can you just pretend that directors' duties and responsibilities don't exist? Well, hopefully, from our session today, you can emphatically say no. You cannot pretend or ignore them anymore. They have serious consequences. And then, can a director be held personally liable for companies' debts, including taxes? Well, absolutely. And if you want more information, please, you are welcome to join us for our next webinar. Can company directors be held criminally liable, which is a roll forward or a follow-on today's session. It is held on the 28th of June 2018, same time slot, 9 to 10. And we will be looking there at the increase in personal liability that we are now seeing for directors. Because with the increase in accountability and your duties, your personal or even criminal liability has increased as well. Are there any questions on today's session? That kind of wraps up our content. Please feel free to send through any questions. It is quite a bit of a technical kind of concept. Some of the concepts are quite technical, and we are trying to simplify it as much as possible. So please feel free to send any questions you might have, and we can break it down for you and make it easier to understand. Just for those who might not see it, the question says, do they actually take directors to court if they don't pay their suppliers? Well, it is a possibility. if you are a supplier of a company and you're not being paid, you have the option to take that company or even the director to court. And you could be put under provisional liquidation. You could be held accountable for the reasons why you are not actually paying that that creditor, if it is that you're acting insolvently, trading under insolvent circumstances, or if you as a director are acting recklessly or with negligence. So yes, that is absolutely a possibility. And it could be any outside person that actually goes and lays a complaint. You've put through a question as well. Thank you for that. Are the director's duties for Section 21 companies the same? Yes, Bert, any companies that fall under the Companies Act and are incorporated under the Companies Act will be required to comply with these duties. Yeah, definitely.
Maybe if I can just add in there, Madeleine, Bert, Section 21 of the Companies Act was in the old Companies Act. The new Companies Act now refers to non-profit companies or registered non-profit companies. But yes, the director's duties are just the same.
Your question, just for those who are possibly not able to see it, you mentioned earlier as well that a director cannot take a salary if the company is not doing well. Does that become a liability to the company? Well, I suppose if you look at it from an accounting point of view, in terms of the entries, it would probably then be a liability if it's not paid out. But for our purposes today, we're looking at kind of a bit of a bigger picture as a director, in terms of you looking at putting the company's interests first instead of your own interests. So yes, you could be drawing a salary, and you should probably be drawing a salary, but if you know your company's not doing well, is it really the right thing to do to continue paying yourself a salary when you know that SARS hasn't been paid? So yes, it could possibly add to the liabilities of the company, but in terms of cash flow, it will have a direct effect. And we are looking at in terms of what are you doing in terms of your capacity as a director to make sure that the best interests of the company are being upheld. I hope that answers your question.
Webinars, about 2 weeks before the webinar, we advertise both on LinkedIn and on our Facebook page. But what you can do is you can just email head office at admin@ban.co.za, and we can give you the dates of the upcoming webinars that we have planned for the rest of the year. See who it's from, is to ensure that they have some engagement or credit checks with customers. If they are trying to collect debt, we have alliance partners in our commercial attorneys, Robin Hay attorneys, that can most certainly assist them with debt collection, and also to blacklist these companies that aren't paying debt on time. But very often it is actually worth taking them or taking the legal proceedings, because as long as there is an understanding that the customer will have to pay those legal fees, I certainly would not just write off debt without taking the legal route first. So I hope that does answer his question, but he's most welcome to contact head office if you would like any further advice. Thank Madeleine again for an absolutely brilliant presentation. I do hope that our listeners, our business owners, have learned a lot from this, and I look forward to seeing the follow-up or hearing the follow-up and having everybody join us with regards to the actual liabilities and potential criminal offences of directors at our next webinar at the end of June. And thanks very much, Shane, as well, for being a brilliant organizer and host. And thanks again to our audience.